Americans are falling behind on their car payments, and pay attention to the Supreme Court because this could be about to get a whole heck of a lot worse. What's up, guys? I'm Nobody Special, and check this one out in Fortune magazine, dated just 2 days ago. Subprime auto lender folds as more Americans fall behind on car payments. American Car Center told employees the business was closing its doors a day after it pulled a $222 million bond sale from the market, according to people familiar with the matter. The used car retailer, which tends to target consumers regardless of their credit history, said in an email to employees on Friday that the firm was ceasing all operations, closing its headquarters in Memphis, Tennessee, and that all employees would be terminated by the end of the business day, the people said. The headquarters had about 288 people. The closure email came a day after the company sent another message to staff saying management and advisors had been working with lenders to improve liquidity and continue operations. American Car Center, which has more than 40 dealerships across 10 states, is owned by York Capital Management. This shutdown comes as more Americans are starting to fall behind on their car payments, and the distress cycle is rapidly accelerating. Before the announcement, American Car Center had shelved a bond deal backed by subprime loans, citing market conditions. Despite investors placing orders for the debt, the firm had not borrowed in the asset-backed securities market for a whole year, with its first sale in 2018. So American Car Center, this outfit has more than 40 dealerships around the country, predominantly in the Southeast. And they're one of these no credit, no problem kind of dealerships. They specialize in subprime lending, which, if you remember from The Big Short, subprime means people who have low credit scores and are very high risk to lend to. Well, American Car Center had planned on packaging up a whole bunch of these loans to subprime borrowers, and they were going to package them up into a bond and sell them to the bond market. At the last minute, they abandoned plans. My guess is the bond market was demanding a much higher interest rate. Keep in mind the relationship between bond yields and bond prices, it's inversely correlated, which means American Car Center was not going to bring in nearly enough cash by issuing this bond. And so they canceled plans at the last minute and decided to throw in the towel. There is another 288 layoffs you can add to the pile from 2023. So what's going on here is people have way overextended themselves, bought way more car than they could afford. And now a lot of people aren't paying those loans, and not to pick on you Gen Zers and millennials, but it looks like these delinquencies are focused predominantly among younger borrowers. Here we are, dated just a few days ago in jalopnik.com. Zoomers are way behind on car payments. People age 18 to 29 hit a 5-year high on auto loan delinquencies in 2022, and the news isn't much better for millennials. Young people are broke. While it may seem like an old trope at this point, there are also data to prove this. Many are so broke that they've fallen behind on their car payments, according to a study done by car insurance app Jerry, which shows that Gen Z and millennials fell behind on $20 billion in car loans in 2022. Everything associated with car ownership is getting more expensive. From the vehicles themselves to rising insurance rates, inflation hasn't made things any easier. Because of these factors, the car buying frenzy during the pandemic reared its head in 2022. Serious auto loan delinquencies, which are defined as having a loan that's 90 days or more late, piled up to the tune of some $20 billion then, and broken down by generation, it gets worse. At the end of 2022, 90-day delinquencies for people aged 18 to 29 hit a 5-year high. It was slightly worse for millennials aged 30 to 39, whose delinquencies hit their highest level since 2019. What's even worse is the debt has piled on at its fastest level in over 20 years. The dollar value of auto loans taken out by Gen Z rose to $50 billion in 2022 and $80 billion for millennials. And those numbers even don't do it justice. There's actually $1.55 trillion worth of total auto loans in the United States. And as we're going to see in this article here in Liberty Street Economics, this is starting to become a bit of a problem. Now, this is produced by the New York Federal Reserve. Younger borrowers are struggling with credit card and auto loan payments. Now take a look at this chart from that Liberty Street Economics article, and this is breaking down the delinquencies in auto loans by age group. Now these are all loans that are at least 90 days past due. And you can see up at the top of the chart, they break it down by the age group. But I want to draw your attention right here. These 3 age groups in particular. You've got people in their 20s, people in their 30s, and people in their 40s. The card delinquencies are on the rise sharply among those 3 groups. People bought way too much card during the pandemic. In the fourth quarter of 2022 alone, more than 15% of all car buyers were signing up for a car payment of more than $1,000 a month. And as we can see in this chart, the problem for credit cards looks very similar. This is the share of credit card borrowers who are 90 days past due. And you can see here we've got another age group. Even people in their 50s are starting to pile up the delinquencies on their credit card debt. People in the 20s, 30s, and 40s are also doing the same. This is Americans putting the cost of inflation on the credit card. And if you're looking at this chart and saying, well, it's not that bad, look at those years past. Well, take a look at what years those were. Take a look at the rate this is rising. The last time there was this much delinquency in credit cards was before the GFC, and you can see by the slope on these lines that the rate of delinquencies is on the rise even faster than it was in the years leading up to the GFC. And also keep in mind that the Federal Reserve is raising interest rates at a far faster pace right now than they were back then. So the interest rate on this debt is getting higher faster than at any point in history. Now, at the beginning of the article, I pointed out that the Supreme Court could be about to make things even worse. And that's because of this one, student loans. Federal student loan payments could restart in roughly 2 months or 6. Here's what to know. This is in CNBC dated February 21st. Federal student loan payments could resume as early as May, depending on how quickly the Supreme Court reaches a decision on student loan forgiveness. The pandemic relief policy suspending federal student loan payments has now been extended 8 times and spanned nearly 3 years. When will the payments actually resume? It's still uncertain. Experts say the Supreme Court hearings on February 28th over President Joe Biden's student loan forgiveness plan will solidify the timeline. In short, depending on that outcome, borrowers could have a bit more than 2 months or up to half a year. So keep in mind when you look at this chart here, showing delinquencies for auto loans on the rise for 20, 30, and 40-year-olds. And when you look at this chart, showing credit card delinquencies on the rise for 20, 30, 40, and 50-year-olds, that this is without student loan payments. Before the pandemic, the average student loan borrower was paying $400 a month for student loan payments. Well, those payments were all put on hold during the pandemic while everybody went out and racked up car loans and credit card debts and big mortgages. Now the Supreme Court could be about to strike down student loan forgiveness, and these deferral programs are coming to an end, so everybody is going to have to start making those $400 a month payments again. What do you think that's going to do to the rate of rise of these delinquencies? It's going to accelerate them, and this chart is going to start climbing even faster. So maybe it's not residential real estate that triggers this one, like everybody's pointing to the housing market, saying, oh, the housing market could go at any minute. Maybe it's the auto loans, maybe it's the credit cards, maybe it's CMBS that causes the problem this time around. Either way, folks, if you're one of these people that's running up the credit cards or one of those folks with a $1,000 auto payment, you need to do something about this fast. These interest rates are going to keep rising. Inflation is going to keep raising the cost of living. And if you're sitting around waiting for the help from the government, you got another thing coming, folks. The time to start getting out of high interest debt was yesterday. Might as well start today if you haven't already. And until next time, live small and dream big.